To put it simply, bonds are loans you make to either a company or a government entity for a fixed period of time. The specific terms of the bond vary, but essentially you give someone money, they promise to pay it back in the future, and they pay you interest until they do. For example, you might buy a corporate bond that lends a company money for 20 years at 4% interest. For each $1,000 you invested, you would get $40 per year for 20 years. Then you'd also get your $1,000 back. There are different types of bonds you could purchase. Three of the most common types include treasury bonds, which are issued by the US government, corporate bonds, which are issued by corporations, and municipal bonds, which are also called muni bonds, are issued by state or local governments or agencies. The main difference among these types of bonds is risk. The US government is less likely to go broke than a company. Because expected return is tied to risk, you are likely to see higher returns with a corporate bond than with a treasury bond. Bonds pay a fixed interest rate, typically paying investors twice a year, which creates income that you might be seeking. Plus, because they are typically lower risk than stocks, they can help reduce the overall levels of risk in your portfolio. Please know that you do not have to purchase individual bonds in order to include them in your portfolio. You can also access bonds through bond mutual funds or ETFs.